Welcome everyone to the Thursday session of Virginia Commonwealth chapter of the Appraisal Institute's State of the Virginia Commercial Real Estate and the Effect of COVID-19 on Valuation. We'll be taking a look at the current perspective of commercial real estate in the state, discussion of COVID-19 and its effect on what we're seeing in our valuation reports and in the market. We're going to start with some economists that are going to provide an overall look in the markets recovering today. And then we're going to shift to market experts in each region. Tuesday, we covered Hampton Roads, Richmond, and Charlottesville. Today, we're going to be covering Blacksburg, Roanoke, and Lynchburg in one panel. We're going to dip up into Fredericksburg and then into Northern Virginia. We'll get started today with our two economists from CoStar. Emiliano and Nick, the floor is yours.
Thank you, Rob, and thank you everyone for having us. Let me go ahead and share my screen. Let me know when you see that pop up.
You're good, Emiliano.
Awesome, thank you. So, good morning, everyone. I am Emiliano Morales Flores. I'm the market analyst for the Southwestern Virginia markets we will go over today. And I am joined also by Nicholas Mills.
Hi, everyone. Looking forward to today.
So today we will go over some of the high-level trends that we have observed across our markets leading to the pandemic, and then also through how COVID-19 has shaped them. First, we will briefly go over each of our markets' economies, and then we will cover the markets by property type, going over office, multifamily, retail, and industrial. And we will hang around until the end of today's session if there are any questions. In this chart, we can look at each of the markets. We'll be covering Blacksburg, Roanoke, Lynchburg, and Northern Virginia. I left Richmond there from Tuesday just as a point of reference as to how the other markets are doing. The blue bars represent the change in employment from the beginning of March 2020 as a percentage, and the difference as of June 2020. The red numbers represent the nominal change of those jobs, so just so that you can get an idea of how big those markets are in comparison to each other. So Blacksburg had the most change as a percentage out of the markets we're covering today, but as you can see, is one of the smaller markets with only 10,000 jobs lost. Most of the job losses in most of the markets and in Blacksburg came from the retail and hospitality industries that are typically fueled by students that left campus early last semester, and also the parents that come in and drop off their children come the fall. Now, Virginia Tech certainly is the largest source of direct and indirect employment in Blacksburg, but there is a decent manufacturing and logistics presence in the New River Valley as well, with Volvo building an expansion that will bring about 777 jobs. Now, that expansion is also coming after a pretty substantial layoff that they had late last year of about 700 jobs as well. So that will end up being about a zero-sum game once that expansion is operational. Down the line with Roanoke, 8% loss since March due to COVID-19. This metro is pretty much the medical central to Southwest Virginia. Carilion Clinic is expanding along with the Virginia Tech Institute of Research that is also expanding. So while EDS and MEDS, as we call them, usually insulate metros from the effects of a pandemic, or my apologies, the effects of a recession, COVID-19 works in a different way than other economic depressions that we have seen in the past. COVID-19 also affected the operation of medical practices that were deemed non-essential. So dentists, non-critical procedures also had to stop and close their doors and were not able to operate during most of the second quarter of 2020, which led to layoffs and led to some of these 13,400 job losses in that area. So if you look back to 2008, when the recession hit, places like Roanoke, Blacksburg, Charlottesville, they had way less job losses in comparison to some of the other growing markets across the country. But now, since COVID-19 has hit education and health pretty hard, they're also suffering quite significant losses. And if this second wave of the virus is not controlled, those may be prolonged into the rest of 2020 and lead to even to an even deeper recession. So moving into Lynchburg, similar to these other metros, there's a large university located there. Liberty's technically the largest university in the US by enrollment, but of course, a lot of that is through online education, only 16,000 students on campus, which do fuel some of the local economy. And they're supposed to come back to campus August 17th. They have not changed most of their plans to reopen campus. So that should revitalize some of the retail industry in the area. And while Lynchburg demonstrated low economic growth leading to the pandemic, that might have actually helped it and allowed it to stay a little more stable through the virus as a result, and a little lower job losses through March and June numbers. So Nick, if you want to talk a little about Northern Virginia.
Yeah, for the purposes of today, I am the Northern Virginia analyst. I also cover DC and suburban Maryland. But for Northern Virginia, we lump together Fredericksburg and Stafford County to the south, and we go all the way out to Warren County to the west. So that's the boundary for Northern Virginia. And as you can see, since March, total job growth was about -6%. It's actually one of the better performers on a relative basis, but it equates to 93,000 jobs. But those jobs are lost in an economy that employs about 1.4 million as of June. So as Emiliana mentioned, leisure and hospitality and retail trade have been pretty decimated. Since March, leisure and hospitality has lost about 30% of its jobs. That equated to about 40,000 jobs. And then retail trade lost about 12%, which equated to about 21,000 jobs. So more than half of the job losses are coming from those two sectors alone. Some of the bright spots for Nova are construction and government. Though the job growth was barely positive, construction projects and federal and state government have kept people employed.
All right, so moving down to office, and as I mentioned at the beginning, we cover the economy, and now we're going to dive into each one of the property types that CoStar covers within our analytics, starting with office.
Yeah, so for companies relocating to the DMV, Northern Virginia is the market that attracts the big names. And it's now sandwiched between two pretty unbelievable demand drivers. The first you have in Crystal City with Amazon HQ. This is going to completely transform the I-95 corridor stretching south pretty much all the way to Richmond. And then the concentration of talent that's going to be drawn to Amazon is going to bring more employers. So we have Crystal City, and then you head 30 minutes west to Reston and Herndon and Tysons, and out there it's cloud computing, cybersecurity, defense technology. You have Silicon Valley firms moving in, Facebook, Google, Microsoft. Walmart Labs just leased new space in Reston. So development is up because of the concentration of the consolidations in this area. We saw it with Capital One and Tysons. We just saw it with Leidos and General Dynamic. Fannie Mae is going to be the latest project to come online in 2022, but don't discount the federal government here with the development. TSA is building in Springfield a new HQ, and the GSA is actively looking for more space and relocation of its agency after just signing a lease that was in the Washington Business Journal yesterday for space out in Reston for Meridian's property. So a lot of development in Northern Virginia.
Yeah, and while some of that has bled into some of the other markets in Western Virginia, like Winchester with the Navy Federal Credit Union and its new facilities, or even the FBI new record center also under construction in Winchester, Southwestern Virginia has a bit of a different story to tell. On Tuesday, we talked about Norfolk attracting Dollar Tree, but also losing Norfolk Southern, something that also affected Roanoke and losing that big office space in downtown Roanoke due to the Norfolk Southern consolidation down to their Atlanta new offices. So this is certainly not the case for all of the Commonwealth. Southwestern Virginia is lacking in the establishment of new office using trends. There have been some gains in new development hubs, like I mentioned on Tuesday as well in Charlottesville. College towns are actually starting to attract upstart companies. Places like even Gainesville, Florida are attracting more companies due to the talent on tap that these universities are offering at lower cost and higher quality of living. But for some reason, that has not necessarily translated in places like Lynchburg and Blacksburg.
So we'll combine the last 2 points here because they kind of go hand in hand. The office using trend has not yet been established, but the leading indicator is going to be sublet space to show the weakness in the office sector. So Northern Virginia, simply because of the size of the inventory, probably leads here. So since the end of 2019, kind of year to date, only 200,000 square feet has been added to the sublet space. So that stands at about 3 million square feet in total. Now, this is nowhere near the peaks of the recession in 2008 and the recession in 2015 here in Northern Virginia. So when we're looking back about 5 years, we're looking at numbers of the sublet space in the 4 millions. So while it's on the rise now, it's by no means a problem yet, which is the reason the employment growth in Northern Virginia has been as strong as it is.
Now, moving on to multifamily.
Yeah, we'll pivot here, and it's kind of the same story with the office, and it starts with the development pipeline. Developers are very active in Northern Virginia, but it is concentrated in certain areas. So we're tracking about 5,000 units that were built this year already, and almost 10,000 units over the past 3 years. What's under construction right now, however, is 35 properties and another 10,000 units. So you're looking at a substantial supply wave hitting areas like Old Town Alexandria, Crystal City and Pentagon City, through the RV corridor. You're looking at Fairfax's main hubs of Tyson's and Reston. That's a lot of competition to enter the market. And even without the pandemic, that type of supply takes a while to absorb. So moving forward on the multifamily side, expect generous concessions and slower monthly leasing for the duration of 2020 until the pandemic finds some semblance of normalcy.
Absolutely. And this, again, the story in Northern Virginia, again, contrasts quite a bit with what's going on in Southwestern Virginia. So places like Roanoke have seen quite a bit of development within their urban core and also out in the county. But the demographic growth has not been there to support a lot more development. So on Tuesday, we also discussed the strength of Richmond and Norfolk as suburban markets and their rent gains as a top 10 markets across the nation. This is something that these southwestern markets also have. They have pretty good rent gains just because of that slow growth. They have been able to keep a pretty solid demand base. And one of the things that is yet to be seen just regarding the Commonwealth is the institution of the moratorium on evictions. And that's why if we look at our data right now, we have not seen a lot of change in the vacancy rates, even with non-payment of rents and unemployment, because landlords have not been able to evict people for non-payment. So once that expires in September, if it is not then pushed further out, we might start to see a little bit of that pent-up vacancy come in as those cases go through the courts. Now, places like Blacksburg have also been propped up by the student demand and roommate living arrangements, and that's why their asking rents are around $1,100, as opposed to places like Roanoke, which have not even cracked $1,000 yet. So these suburban markets have remained in a pretty strong place when it comes to rent growth, but we still have to see how the changes in vacancy will affect the rent growth going forward once those evictions start coming into play.
The trend actually holds in Northern Virginia as well. most of the strength we're seeing right now on the rental side is coming from outlying counties. So think Loudoun, Prince William, Spotsylvania, Stafford, Fredericksburg. They're attracting households that opt to rent. And because the rents are frankly vastly lower than closer in areas, Arlington, Fairfax, landlords have found plenty of room to push rents, even during the pandemic, which bleeds right into the fourth point here is a lot of investment activity over the years in Nova, but since March, about $500 million has been invested, which is pretty remarkable considering the capital markets has been pretty frozen since March. So that comes in at about 20 properties, trading around an average of 180,000 per unit. Crystal City and Inner Arlington are still the hotspots, but areas like Fredericksburg and down I-95 has produced some big time sales. One of those being the $90 million deal for Kensington Crossing, which actually closed in July. On the buyer side, it's mostly localized players. Starwood Capital Group picked up an Alexandria property for $30 million. Outside of them, it's companies like Cherner Development in Vienna, Jarl Lynch, Insight Property Group in Blackfin. So local players familiar with the area are making some pretty big claims with the capital that they have available.
And similar to Northern Virginia, Southwest Virginia has not seen as much deal volume, but it's a similar story with local players. But in this case, it would be smaller properties being traded at higher cap rates, looking for those higher yields and the rent growth. So moving up to retail, downturns tend to not necessarily create new trends, but also accelerate existing trends. So in Southwestern Virginia, there was a diminishing development of retail, and that was just mostly because the demand wasn't there. Most of the retail that was being built was built to suit, and even grocers like Walmart have been forced to close in the last few years due to poor performance. So when it comes to retail, mostly restaurants like Chick-fil-A lead development in these southwestern markets. Less than 500,000 square feet have been built in Roanoke since 2013. And that's why vacancies do remain low, not necessarily because there's a lot of demand, but there's not a lot of supply. And most of these landlords are prioritizing tenant retention over rent gains in these markets.
It's a little bit different in Northern Virginia. Negative demand is sending vacancies up. That's nothing new for NOMA, but more often than not, demand is pretty robust in Northern Virginia, especially for retail. The area is expected to endure probably a few more quarters of negative demand, and we have the vacancy rate soaring past levels not seen since the Great Recession. And it starts with leasing activity. It's almost completely shut off. Not even in the years of the BRAC and sequestration budget cuts did leasing volume drop this far. And it's a really tough time for Nova, especially with Arlington and Fairfax being hotspots for cases, and the counties have been slower to reopen. It's limiting demand, and all that mixed use space that's underway is opening without any committed tenants as they wait to figure out and shake out what's going on.
Yeah, so again, on that same thread of increasing vacancies and less construction, even, the malls were already closing, and that's why Carilion Clinic even signed a lease to take over a vacated JCPenney and Tanglewood Mall in Roanoke back in 2019. So all of this has led to investors going for, more secure bets when it comes to retail, more now in the age of COVID-19, when one of the few retail sectors to actually increase their sales were grocers.
Yeah, there hasn't been a huge amount of investment activity in general. On the retail side, it's usually happening from some large consolidation at the REIT level. But one of the local companies around here is an investment company called Fundrise. They went big and put up $70 million for 3 properties in Alexandria. They acquired anchoring that deal that closed in March was a Harris Teeter off of Eisenhower Avenue in Alexandria. So strategy, grocery anchored centers take advantage of foot traffic, and find opportunities when you can if you have capital that's ready to be deployed.
Absolutely. Now, moving on to industrial, I know we're getting towards the end of our time.
Yeah, so the Nova industrial sector is interesting because not much manufacturing and distribution typically is a little bit further south with no port. So what industrial in Nova is the data centers. It has the most concentration of data center and warehousing in America. Most of America's internet flows to the region. Generous concessions brought the heavy hitters to this area over the past decade, and demand is so hot for this stuff that there's millions of square feet underway, and the properties are popping up pretty much everywhere. They are concentrated in the Loudoun County area. But from an industrial standpoint, leasing volume took a pretty big hit in March. But entering March, it was one of the strongest quarters of leasing activity that we've seen. And this is all led by Amazon. But think about Google, Microsoft, Facebook, they all have operations here. And they're also looking in Southern Virginia too, as you heard on Tuesday. They're looking for the East Coast companies. They're looking for the density of people, the high earners, and that availability of land and distribution runs along 95. And it's no surprise why they're here.
Absolutely. And Southwestern Virginia, not as many data centers, but has seen a little more development on the manufacturing side. Elder Corp coming into the Roanoke market in 2018. I mentioned also Volvo increasing their operations down in the New River Valley area with a huge expansion to their manufacturing plant. And that same company, Volvo, is also increasing their footprint across the 81 corridor. Just at the beginning of the pandemic, they actually opened a new Mack Trucks assembly plant in Roanoke as well, which I spoke with John Hall from the local EDA, and he said they pretty much kept it covered up until they actually started operations back in the first quarter. So there are still some things going on for industrial in these Southwestern markets. However, places like Roanoke do face a pretty interesting challenge with their geography. And unless there's already something built, it's pretty difficult to level out land surrounded by all those mountains for new development. So that's one thing that has constrained some of these markets into building new development while they are pretty well located across the 81 corridor.
Not much here to add to this last point, and we'll wrap up with this last idea. Any development in Northern Virginia has been coming down I-66, or it's near Manassas. It's down 95. Fredericksburg's been a hot spot, but the largest deal, not surprisingly, is an Amazon distribution facility, 200,000 square feet. It sold in June at the height of the pandemic, and it closed at a 4.5% cap rate. The buyer was a Denver company. So you're seeing some money flow into the region. It just depended on the asset specific. So despite the ongoing trends of industrial, e-commerce, and distribution, we haven't quite seen that investors put up the dollars to solidify that trend just quite yet.
So again, I want to thank the Virginia Commonwealth chapter of Appraisal Institute for having us today. If you do have any questions and we're not able to answer them towards the end of the session today, please feel free to contact us. Our email and phone numbers are there for you to reach out. And thank you again for your time.
Nick and
Thanks,
Emiliano,
everyone.
yeah, thank you guys both. Great information. And for all the attendees, we'll get this presentation posted next week for anybody that needs to maybe take a look and sample any of that work. And please reach out to these two. Their assets to Valuation as well as to CoStar. Thank you, guys. Now we're going to shift to the Southwest Triangle, Blacksburg, Roanoke, and Lynchburg. Today we've got Mike Russell, MAI from Russell & Associates, Joe Thompson, MAI, Thompson Valuation and Consulting, and Billy Hansen, MAI from Hansen Realty Advisors. You guys have the floor.
Okay, I guess I can get it started off. First of all, thanks, Rob. appreciate all the work you and Keith have put together in Atlantic Union Bank for doing this. It's been a wealth of information for me, and I know it has been for a lot of the attendees. Describing the current situation, I guess what the way I look at it is I compare it to the last recession. And, people were always asking me, Mike, what's going on? What's happening with values? And in the last recession, the way I explained it, it was the simplest way I could figure it out is that, you've got two sailboats on a lake, and, one is a 5-foot dinghy with a small sail, and you got another one with a yacht with all the bells and whistles. The problem is in the last one, so we had no wind. So it didn't matter what you were driving. There was, the banks weren't lending, nobody was selling. We were having all kinds of problems. You just couldn't get any momentum. The way I describe this COVID situation is a little different. It's, I think it's more like, a kid with a bike with the governor on it. Wants to go fast. He knows he can go fast. The fundamentals were there prior to this hitting, and we're just waiting for the governor to come off. And I think that's the best analogy I can give in this situation. So having said that, I know there's a lot of negative stuff going on and everybody's kind of sitting on edge and nervous, but I'm going to focus on some positive stuff. I think, as appraisers set values sometimes in the market, I think our conversations here maybe sets the attitude going forward. So, I don't think we're going back to pre-COVID conditions. I think some of this stuff is getting baked into the business models. I think you drive around and you see these businesses and you understand that they're adapting pretty quickly to this. And I think we're going to see some of this stuff evolving. I think it's important that it does. So starting off, I'm going to start with our rising star. I think industrial in Roanoke is becoming, like I said, the rising star. What's happening. Everybody saw the supply chain problems that we had, even trying to get stuff through the mail, trying to get everything taken care of. I think Roanoke being close to the interstate, we've got opportunities. There's a developer right now that is, I talked to a broker the other day, and he's searching sites in western Roanoke County between Salem and Christiansburg, looking for that last mile warehouse, because I think the logistics of getting the shipments and the deliveries to the homes. I mean, my wife ordered something over during COVID. It took them a month for Amazon to get it there. And it wasn't because they didn't have it. It was just they couldn't get it to the site. So I think Roanoke is looking at some of that. I think there's some opportunities there. The problem with Roanoke is we have such an old inventory of inner city manufacturing and warehouse with functional problems with not enough loading docks and ceiling height to accommodate. So hopefully we can see a little bit of new construction going on there in that sector. Again, and I think the trade tariffs are having an effect. What used to be, you'd go overseas, especially to China, it would be affordable to build your manufacturing plants overseas. And I think the tariffs are kind of equalizing that. And we're starting to see some activity, especially along the Shenandoah Valley 81 corridor. I was talking with a Collier's broker the other day, and he said there's money flowing into the market looking for opportunities for distribution warehouses and stuff like that, and even manufacturing, which could be coming back. The star in Roanoke, as far as I'm concerned, has been the apartment market. We've got some aggressive real estate brokers, and what they're doing is they're contacting people. And Roanoke is an older market, and they tend to hold on to their properties. And just like the folks from CoStar said, it's mostly smaller properties under 30 units, and they're contacting. They're saying, hey, look, you bought this property in 1975 for 25 or 30 a unit. I can get you 55 or 60. And, you've got a widow on the other end of the phone, and she's saying, yeah, I don't want to deal with this because my husband took care of this. And so there's been a lot of sales. The cap rates are hovering, around 7, high of 11 on some of the older properties that need some work. Averages, probably in the 7.5 range. We just had our first sub 6 apartment sale, a 36 unit in Southwest Roanoke County. sold on the downside of a 1031 exchange. And but I mean that's all good stuff. I think we're seeing 4% and 5% rent increases on the apartments. So it remains the star in the Roanoke Valley. Moving over to retail, I was sitting in the parking lot of a convenience store the other day, and I was masking up, and it's amazing how a few months can make some changes. I'm sitting there thinking it used to be that if you would put a mask on and go into a convenience store, they'd probably call the cops on you and think you're a criminal. And now, if you don't put the mask on and go into the convenience store, they'll probably call the cops and think you're a criminal. So it's a paradigm shift. We're upside down. But having said that, I think there are some real bright spots in the retail sector. I think the restaurants are doing well. Some. The mom and pops are probably going to go away. If your business model is not geared towards takeout and delivery and curbside pickup, and if you didn't jump on that pretty quick, then you're going to probably suffer. And we're going to backfill some of those spaces. But I think I talked to the local Bojangles franchisee. He said, I hope we don't open the dining area, the in-store dining, because the takeout has been so strong. And typically it represents 30 to 40% of the business. But I think we're going to start seeing prototypes, smaller prototypes. Talked to a retail broker the other day. She said that basically, some of the Starbucks is looking at a smaller prototype, and they're going to try to do double drive-throughs, and they're even considering a walk-up pedestrian window, probably for some of the more urban locations. But so I think there's some positive things there that are going on. Let's see, office. As CoStar experts said, we're dominated by the Carillion. I mean, their buying practices, they're leasing spaces, they're selling the space if they can't lease it. We're seeing HCA Lewis Scale is doing they're doing a brand new dock in the box out on 460. And Carillion, like I said, is spending $30 million on a 25-year lease for 150,000 square feet for their new pediatric center in Tanglewood Mall. So that's a repurpose, and we're going to see some more of that. Office and medical cap rates, they're anywhere from mid 5s to 11, depending on the property type and the leases, averaging about 8.5. Vacancy rates are somewhere in the 5 to 10% range. The takeaways as far as appraising is concerned, I think what's happening, especially in the retail, is we need to look closely at the force majeure language in the leases. So when you do your lease audit, I think it's important, because I've been told that that language is going to change, and some national retailers are going to fight for some of that language. If they have 3 months downtime, they're not obligated under the lease. So I think it's good for us to take a careful look at that. What was once considered boilerplate, you just skim over it. But when you do your lease audit, I think it's important to look at that, and because that could affect the cap rates, especially, we've already saw early termination clauses in these leases. And I think this is going to be something going forward. So, with that, I think I'm going to wrap up, and appreciate it. Thank you.
Thanks, Mike. Joe, you next, and Billy is back with us.
Okay. All right. Well, being that we're doing Southwestern Virginia and Northern Virginia at the same time, I'm a little depressed with some of those, back-to-back facts. So I got to hit y'all with one good one, okay? So like has already been mentioned, Carillion is the elephant in the room. What they're doing with Virginia Tech down, with their expansion, cancer center, pediatric center, Mike mentioned. I mean, all this, I was with some of these board members last week or a couple of weeks ago, and I said, look, what's the net effect of employment? What are we going to be seeing here? I do these projects too on the side, and I said, look, everybody in this room's livelihood relies on this. Tell us the answer. and they're committed to 15% employment growth. Okay, so I realize not all those people are in our immediate area of Roanoke City, Roanoke County, but a majority of them are. 7,500 of the 13,000 are. So if you take 15% of 7,500, just right there, you're at 1,100 plus. Okay, so that is a very positive figure, and that's not the research jobs that are coming to the new building they did. And not Virginia Tech, which Virginia Tech, that's probably going to slow up. They don't know what they're doing with their campus. Why start another one? They're just going to have to work through everything. But anyway, that's a positive item. And let's see, I wanted to just touch on a few things. Mike hit on the major property types. I'll just touch on self-storage real quick. Self-storage actually had a pretty decent leasing season. Not a lot of move-outs, lower numbers and velocity, but the lack of move-outs really, it boosted occupancy a little higher than one would expect. Okay, so from there, rate increases weren't really possible. In fact, some states said you can't do it. So if you look on the REITs, which actually is fairly in line with the mom and pops, if you really start going through everything, you'll see some good indications. So you had a slight drop in NOI. Just because some added costs, you got to help your employees out because they got childcare expenses, things like that. And, from there, the net effect is pretty good indication of resiliency. Is that boosted by, the check everybody got? Potentially. But overall, when you compare retail to self-storage, where would you rather be? Self-storage, no question. Let's see, another operating property type would be event venues. I've done quite a bit of research on that lately, and it's been interesting. Nobody's getting married in a packed hotel right now, obviously. They're going to be, searching around, where can I get married, on a weekday? And so these outdoor event venues that have, closed up and now reopened have been slammed. There was already a good amount of new supply coming online. Maybe banks being a little hesitant right now might slow that up. Maybe a worse recession as we go forward might slow that up. But I see that being more of a prominent trend, as it already had steam. Now I think that's going to continue. And the rates are going up on that. When you're doing 2 nights, every weekend, but now you're adding in 2 nights a week, that does a heck of a lot for your revenue, no question about it. So I would see that trend continuing. The last operating property type I'll mention is the car wash. That, has been something that in all our markets we've seen. In each of our markets, we'll see multiple groups searching out to do 5, 10 of them. Maybe not so much 10 in Lynchburg, maybe 8 or so would be a target number in Roanoke, but there are not one group, not 2 groups, multiple groups that are chasing that type of deal. And while costs have increased, there used to be a better margin, people are still making the numbers work, no question. And, on the sales side, CoStar's competitor, I'll tell you, I put up a car wash we leased to Zips, the largest operator, and within 15 minutes, somebody who had to have that bonus depreciation bought it off the CREXI website. I'm not even sure, was it Crexi? So it's a hot market, and the bonus depreciation rules have only exacerbated that. So with that said, just to touch on a few items related to how COVID's affecting things. I've talked to some retailers and worked through some of this with some of my tenants myself. And ultimately, if you've got somebody who's crying the blues, the first move is, you've got to get their financials. That's going to be all over the board. I've got, for instance, one tenant, I was like, man, we're going to work together. We're going to get through this. Local, not a franchisee, not having a large franchise coach them how to screw landlords. Looked them in the eye. They looked me in the eye. Hey, let's work it out. All the banks are giving interest, interest only deferments, some full deferments. So, I think as a landlord right now, you have that responsibility to pass that through. But I'll tell you this, after the financials come out, that's when you can see, there's some people who are just, oh no, don't worry about it. Don't worry about it. They were embarrassed to show you they were still making pretty good money. So that's something you got to understand. You're going to have franchisors telling franchisees, here's the game plan. Go save some money. Come on, do it. We've just dealt with a variety of situations, but ultimately everybody's back on track. I had a haircutter that was shut down. Now they're back on track. I went and got my haircut now. I thought my bald spot went away, but she found it again. So, but anyway, they're slammed. I mean, they got a line out the door. They got a seat outside. I mean, they're slammed, no problem. But, their corporate sent out a letter. Oh, we need this and we need that if we're going to survive, and called him. Nah, we're fine. We're taking a little time off, doing some renovations. Next thing you know, they're popping. So you just got to work through every situation, every location, every tenant's going to be different. And as far as long-term value, yeah, there are going to be restaurants that don't make it. And probably we're on such thin margins that it was inevitable anyway at some point as the economy went down. Mike did not touch on land, and I think COVID is going to somewhat normalize things in Roanoke. I mean, land values are ridiculous in Roanoke. There's not a lot of flat land. There's not a lot of good land that doesn't have a heck of a lot of rock, or, have extreme need for site improvements, whether it be stormwater, whether it be, retaining walls, whatever. And, at this point, I look at restaurants. I mean, Regazi was gone before, but that's a site that's available. It's, I think it's under contract right now, but Regazi's, yeah, they weren't going to make it. I look at, there's an Asian restaurant that, is a local Asian restaurant sitting on a great corner on Franklin Road. They got to sell, right? They already had COVID incidents. I'd say, they're dwindling. You got all these restaurants that are pretty good locations, but probably ready to go. And I think over time, that's going to normalize things because sites were too high. There was just, Mike, you said the Lewis Gale or the HCA. I mean, that was upwards of $2 million on a corner in Roanoke, Virginia. We just sold an acre for 1.3 on Franklin Road. You remember one just bought a dog site for $1 million. I mean, the list goes on, and I think this is going to increase supply to a reasonable level. But I think that touches on everything. If y'all want any more information, just shoot me an email and I can try to elaborate on some things too.
Thanks so much, Joe. A lot of great information there. Appreciate your experience and sharing your information.
Yeah.
Billy Hanson.
Yes.
I think you got the floor now.
All right. So I'm Billy Hanson. I'm in Lynchburg, Virginia. I am a commercial appraiser and broker, so I wear two distinct hats. And the most common thing that I've heard throughout this process has been, residential is on fire right now. You commercial guys must be killing it. And that's from your average person you meet on the street. And the first part of that is right about residential, and the second part is completely wrong. And I want to walk you through how that's right and how that's wrong. So they are correct that residential is hot right now. If you look at our market year to date, from 2019 year to date to 2020 year to date, sales are up 12%. Volume of residential sales are up 12%. That's even with March and April being almost non-existent for sales. Prices are up 8%, and price per square foot is up 6%, and days on market are down 37% in residential. So they're absolutely right. It's on fire. Houses sell within the first week. Residential has done $500 million in volume so far year to date. I mean, that's huge for Lynchburg. So they're right about that part, but it doesn't translate to commercial. And I want to sort of show you why and show you how. So it's been a different story. So in commercial, I want to look at the last 6 months. So from today, 6 months back. So right around when COVID got real, we've had in Lynchburg since then about 25 commercial sales. That's not very many. About 7 of those were land sales. And a lot of those were deals that were already in process, sort of pre-COVID deals. I mean, commercial takes a long time. You know, it might be on the market for a year, it might be under contract for 6 months. The deal was already kind of underway. And person developing, whether it was residential development or commercial development, it's going to take a year to build that out. And if you're an optimist, you think in a year, next summer, things are going to be all right. So those deals kept going forward. So that's about a third of the deals. 4 deals were industrial deals. Our industrial market's very tight. It's very hard to find something industrial to buy. So a few old owners who had been kind of hanging on decided to let some stuff go, and that stuff sold quickly at top dollar, even during COVID. And that's just because industrial has always been high demand, low supply. And one of the only distressed sales that I've seen throughout this whole process was an industrial property, and it sold after 2 days on market for asking price. So it sort of shows that in different sectors, different things are happening. We've had a couple apartment sales, 2 or 3, but apartment owners aren't selling right now. They love the asset they have. They haven't sold for years. Tons of people want to buy apartments, but people aren't selling. Because of all the asset classes, that's the one that has been doing well for most people. We had one downtown rehab project that sold, and that sold for about 25% off asking. And that person's going to bring apartments to market. It's going to take a year. So doing your construction during COVID doesn't bother you because you figure by next year it's going to rebound. And then the last third of the sales were kind of small commercial office retail, what my colleague used to call piddly stuff. That was sub 250. So sales under 250,000, usually a local seller, local buyer. So that's the 25 sales we've had in the Lynchburg market. So I want to compare that to the 6-month period for 2019. So we had that for this 6 months. Let's say that same 6 months, February to August in 2019. In Lynchburg, there were 38 sales. So not that many more. It's not a huge change in amount of volume. I mean, it's significant, but the difference was in volume. Those 38 sales had $82 million in sale volume. These were significant sales. These were where brokers make livings, right? This is where they get paid and big deals are happening. The sales volume for this 6 months was $10 million. So it truly is just kind of small stuff. So if you know a commercial broker, you know, send them a hug, a condolence or whatever, because their income is down. Like that's just factual because leasing volume is also off a cliff. So we see a huge difference in volume. The other difference we see is sale price to ask price. So last year was about an 8% discount, sale price to ask price. This year, it's an average of 35%. And that's significant. The other thing we see is the amount of square footage that sold within that sales. This year, it was 400,000 square feet. Last year was 1,000,004 square feet. So what you're saying is this huge volume difference from last year to this year. And the reason for that is something I call the gap between buyers and sellers. There's always a gap, but I think last year it was tighter, and this year it's gotten much wider because sellers still want the price they could have got pre-COVID, but buyers don't want to pay that price anymore. The only thing kind of propping that up is interest rates. I hear about these low interest rates more than I hear about anything else. Buyers want to do deals. They have cash, money is cheap, but it's hard to bridge that gap right now. 2 other anecdotes. I think the key question to ask is, have the fundamentals of the deal changed? If you're appraising, have the fundamentals of it changed? I had a deal that was under contract for an office sale leaseback. It was about $1,003,000, $1,004,000, and a law firm was the tenant. It was under contract pre-COVID and still sold after COVID because the deal hadn't changed. It was still good income from a good tenant. Both buyer and seller were happy to keep going with it. I'm helping an affordable housing developer buy land to put 40 units in Lynchburg. We were under contract pre-COVID. We're closing next week because affordable housing is still a need. They still want to do that deal. So there are deals that are still getting done as long as the fundamentals haven't changed. So, is that good, Rob?
Yeah, no, Billy, I appreciate it. It's great insight, and appreciate you bringing your broker hat today. It's kind of the cutting edge for us. Great presentation from our Blacksburg, Lynchburg, Roanoke, Southwestern Triangle group. Now we're going to shift to Fredericksburg market with some land and timber sprinkled in from Stuart Holtzman. Stuart, you got the floor. You might need to unmute, Stuart.
There we go. Can you hear me now?
Yes, sir.
All right. And at the end, I'm going to share my screen just to do it once so that I don't have to jump up and on and off. Really great presentations. I was on the panel on Tuesday very briefly. Had to kind of wrap it all up in 3 minutes for land. But I got a very interesting email right away from another MAI. So just to let you know, other people are watching and they were very grateful. And he said something very interesting. He really appreciated you all and the individual experience of the MAIs, and certainly MAIs and brokers that are out there on the market, because they're, now, I'm going to get to my conclusion first and then tell you the good stuff. Because we clearly have a divided market, and I appraise mostly land, and I've been appraising over the last 6 months every type of land except industrial so far, but hotel, retail, multifamily, office, a lot of residential, and timber. And developers have typically a little bit different view. Most developers will tell you, find me something that I can do now. I want to get in before things change. So they're looking at underlying fundamentals, and they're not looking at COVID particularly. They're saying, for example, in the residential market or the commercial market, different areas where there's a good deal, I want that now, because they're very uncertain about 3 to 5 years from now. And I started hearing this at the end of 2019. And I understand this because, for example, we had a panelist on Tuesday that talked about recessions. And I remember at the end of 2019, early 2020, developers telling me, I interview them all the time, builders and developers, you know, we're waiting for the shoe to drop, or the other shoe to drop, however you say it, because we live in an economy that's cyclical. And most people are talking about recovery from the COVID recession. And in that sense, I can spend 3 hours on land and tell you how great things are, especially the residential side, and you know, industrial, certain areas. Timber that's where a lot of the money's going, by the way. People are putting it into safer investments like triple net leased and timber. I'm going to show you a slide that shows the rate of growth of a timber investment over the last 30 years has been 9.3%, well above the S&P. And the reason is that timber grows in value at about 5% per year, while the underlying land is growing at 3 or 4%. Now, that's not necessarily in the southernmost Virginia, but in most of the metro markets. And there is a lot of land going into timber. And if you've got the last section of a residential subdivision, or if you've got a relatively small one that can be sold out in 2 years, that's going to fly off the shelf. And just like a lot of people have mentioned, at what we would consider typically above market prices. But it looks to be short term because there are underlying fundamentals that would indicate that we are going into a down cycle in the economy. And if you compare where we are now, if you just compare recessions over time, like Ed Knight was saying on Tuesday, and we can expand on that, the beginning of a recession is characterized by a few things, and several people have mentioned that. Buyers and sellers' expectations changing, a separation in the market among property types and regions. Federal stimulus. I've got one thing to say about federal stimulus and also lender stimulus. So when you see these things, that's usually when you're entering the beginning of a down cycle. And so maybe by next year, we'll be looking at sales prices falling, vacancies rising, rents beginning to flatten. This is what developers are looking at. And I've got one thing to say about the trillions of dollars of money that's being artificially pumped into the economy. The bill comes due. And we know this from prior economic cycles. No, I don't think we're entering a big collapse like the great financial crisis. But the people I'm talking to are looking long term. And so that's kind of the downside. And I think all of us, certainly what I'm trying to do as appraisers for the bank, like for Rob at Atlantic Union Bank and Rocky, thank you very much, by the way, for putting us all together and doing this, is looking at my discount rates very carefully. During the great financial crisis, as an example, residential discount rates for under 100 units, according to realtyrates.com, dropped about 350 basis points from 2007 to 2009. It took almost 8 years to recover that. So when I'm looking at a maybe 5 to 10 year cash flow, I have to consider that the future is not going to be as bright as once we recover from COVID. So we've got two things going on. Yes, things are going great as we recover from COVID. But as everybody has said, it's different in different markets. And we've got these signs. People are not building speculative. They're not grabbing up land to build speculative like they would at the beginning of a recovery when they know the future is only good from here on. And of course, all of the stimulus, if mortgage interest rates just go back up to 4.5%, that's a change in almost, it's about from 3 to 5 is a change of almost $17,000 in household income. And with a jobless rate at 10% and above, and when you throw in independent contractors and people that are partially employed, that's more like 15 to 20 of real unemployment. That creates the demand for every property type. And so this is what the developers are telling me, and I'll give you the worst example. I had to appraise a significant hotel property, land in Richmond, something none of us would want to have to do right now. And Oxford Economics, STR, Smith Travel Research, CoStar, Wells Fargo Advisory Group, they're all forecasting at least 3 years for RevPAR to return to pre-COVID levels. So pre-COVID, the deal was under contract at X amount. And as soon as COVID hit, the seller came to the buyer and said, I know you're going to renegotiate. Please get your appraiser back out there, and X is the lowest number we'll go. And so I reappraised it. I didn't quite come in at that lower number. I didn't care, obviously, either way. But the difference was about 35%. And that's how far the seller was willing to go, because he knew that a hotel property, this was for 800 plus units, was not going to sell. I asked several developers on that project, hey, look, if all the market data was saying it's going to be 3 years until RevPAR recovers, would you accept a, excuse me, a land banking discount of somewhere between 7 and 10%, say equaling 25 to 30% off the sales price? And all of them said that would be a good way for me to look at it. And I'll tell you why. I would take as little as 25% off right now, because yes, I know it may be worse, but if it's any better, I'll start building in year 2 and I'll hit the market ahead of everybody else. So that's one way that I'm looking at things, is this kind of a discount up front until things at least recover in certain types of markets like retail and hotel. With respect to residential markets, does anybody even need to be shown most of this? Probably not, but very quickly, in the greater Fredericksburg market, as everybody has said, where we were at, these are running totals of housing permits. Basically across the board, we are at least or better through June. May was the biggest month nationally for home builders. They reported greater sales volume than they had ever in their history. Ryan Homes, which has a presence in Pennsylvania, reported their biggest volume ever, even though Pennsylvania was literally shut down for closings for all of April and May. I know all of May. I'm not sure about all of April. So we get confusing. This is an article from one of our data sources, and it says the first one is home equity levels improve across the nation during the pandemic. The next article is residential foreclosures could easily double over the coming year. So we got really good stuff short term, not so sure about the long term. This is that timberland relative to stocks and bonds, 9.3% growth over the last 30 years. Timber prices have gone up from 21 to 24.5, and that's one of the main reasons. That's the prior recessions, how long it takes to recover, and we all know that housing is the best, but we're also getting stuff like this. This is from Appraiser News Online, which we get. We're getting this every day. Home affordability drops to 18-month low. Average sales prices rise. Resident foreclosures may double. And then in every multifamily, fundamentals too slow. Of course, restaurants, residential, banks tightening. These are all indications that we have a split economy. And the way that I'm dealing with it is I've got a full section on COVID-19 and all property types. I don't even know how to get back in there, so I don't know that it matters. On all property types, stop sharing. Right up front, I'm using bifurcated adjustments in my market condition adjustments. So maybe an appreciation through February, but perhaps 0 cents depending on the property type. I'm looking at my discount rates long term, and I'm talking to a lot of developers and brokers because that's what I have to do in my particular situation. And I'm spending a lot of time on webinars just to try to keep touch. But like I said, it really is a great thing to be appraising certain property types right now. But over the long term, I think we've got to look at where we are in the economic cycle. And I know we're all doing that in a different way in our property types and markets. The last thing I'll say is this was encouraged by the Appraisal Institute. The IRS also came out and said this regarding conservation easements. Do what you have to do. Say this is the best information, but use that ELC that we recommend these properties be reappraised more regularly. And if anything changes, I reserve my right to modify my value conclusion. And I reserve the right to modify what I just told you all. Give me 6 months. Thank you. And thank you, Rob, again.
No problem, Stuart. I appreciate the information. And thanks for reminding all of our valuation folks on the line about that limiting condition in your reports. It won't hurt to drum up some more business. And some that think that we're close to out, we're not. So it's important to let people know. You might want to look at your numbers more frequently than you normally do in the past. Thanks for your time today, Stuart. Really appreciate it.
My pleasure.
Yes, and at this time, we'll go to our panel from Northern Virginia. Jerry Harvey, MAI from CB Richard Ellis, and Tom Shields with Joseph J. Blake. You guys have the floor. Jerry, you might have to unmute.
Okay. Well, I might have to take over a little bit. Jerry's he texted me a little while ago. He's having some internet problems. So I might have to start this on my own here. But hopefully he'll come back on in a second. We wanted to cover the four major markets in the DC area, the Northern Virginia, which we're putting in order of healthiest to weakest. The order I've put them in is multifamily is probably the strongest, industrial. The only reason I'm putting industrial second because it's a limited market here, but it is very strong as well. Then we look at office and retail, which is a bit more trouble. So one thing that I've been lucky enough to do, I have about 40 to 50 properties that I appraise on a quarterly basis. So, and for all property types. So I get the unique perspective of talking to these owners and investors who are also out there buying and selling properties on a quarterly basis. So at this point, we've gone through 2 quarters through the pandemic. So it's been very interesting because they've been very forthcoming, more than they usually are, on what's going on in the market, both positively and negatively. I know we found with industrial, they felt at first we were hitting it too hard, that they're finding there's still very strong demand for industrial properties. On the other hand, for retail, the opposite. We weren't hitting it hard enough. So they've been very forthcoming. So it's kind of given me some good perspective as to where values are heading. So with that in mind, and with the limited activity in the market, especially a lot of the sales that have taken place were already in the works before the pandemic hit. So there hasn't been that many sales that have started and ended since the pandemic. So what I want to start off with is the multifamily.
Yeah, and Tom, if I am back now, can you hear me on audio?
Oh yes, I can. Okay, Jerry.
All right.
Yeah, so I kind of went through our introduction. If you want to, if you have any questions for me, I was going to cover the multifamily. So why don't you start with any questions you have?
Yeah. So where do you see underwriting these days in terms of class of property, whether it be A or B, and in terms of any locations that are stronger than others?
Okay, let's start with A, because that's what I've seen the least impact. I mean, there's certainly been some negative. There's the absorption of newer properties has been slower. Leasing has been a bit slower, so there's some increases in concessions. Most of these, though, are thought to be very short term. And so I would say, as far as underwriting, other than maybe ticking up the credit loss, especially on a short-term basis, and, on a DCF basis, maybe a little bit lower growth. But overall, and given the interest rate environment, the overall impact is minimal. For example, we are working on an appraisal of a building that's under contract, a high-rise, not at a metro location, very good quality property, and it's selling at a 4.25 cap rate, which is as low as we've gotten in the market. And this is a sale that, was negotiated since the pandemic started. Now there's, it's about 5 or 6 miles from the new Amazon headquarters, so that had something to do with it. But we've also seen some sales, even though there's been limited sales, and sales that have taken place have been at very aggressive levels. There's a sale in Herndon that recently closed, and that was a sub-5 cap rate. For out there, that's pretty aggressive. So I think overall for the A properties, minimal impact. There's still wait and see attitude, though, to see how long this pandemic lasts. So the one concern I've heard from investors are on the workforce housing, some of the B and C properties, which in relation to the DC market as a whole, I don't think Northern Virginia has as much of that inventory, but there is still plenty of it. And the concern there is that everything's fine right now, but once the forbearance and the unemployment benefits go away, that there could be big problems there, especially if people aren't getting back to work and restaurants and stores aren't opening. That there is concern there, because that could really take a hit on vacancy and credit loss, obviously.
Tom, it's funny. I've had the same issue, especially on the B value add properties. We just finished up a job, a very large more of a value add property down in Alexandria. It was a $536 million deal initially, and it went through underwriting, and then it was retraded down, about 6% to about just a little over 500 million, and that was all due to COVID. And I think it has to do with some of the issues you just brought up.
Yep, that's interesting. Yeah. Well, I guess we should go on to the next category is industrial. And Jerry, you're going to cover that. What are you seeing in the market right now?
Well, industrial is definitely one of the stronger property sectors that we have. I mean, in Northern Virginia, we have vacancies under 10%, and in the active submarkets, a lot of them are under 5%. So there's not a lot of space, particularly if you're an essential tenant. There's a very strong demand from e-commerce and logistic facilities, as well as cold storage, obviously, to help out with the grocery stores, which all around the region are doing very well. The biggest stories are really on the e-commerce and logistic facilities, your Amazon and FedEx built to sell deals. Those are, they're basically building to a 6 to 7% return on cost and selling these in the low to high 4% cap rates. Depending on where your leases are. If you have a flat lease, it's going to be on the higher end of the range. But if you've got bumps in your leases, I've seen some trending on lower. And there is a very big appetite from international investors on some of these last mile portfolios. The high bay traditional warehouse is also still in demand. We've been getting a lot of requests to appraise those. But you got to be careful with those properties, based on the tenancy. Some of the properties that are single tenant properties or have large amounts of spaces related to retail stores and malls or warehousing or gyms, churches, restaurant suppliers, catering. Those are going to have some hair on it because the condition of those tenants isn't really that good. We're seeing a very good appetite in the Route 28 corridor, and also, down the I-95 corridor. There was just a recent sale we looked at. It was a FedEx sale down at Capital Distribution Center in Springfield, and that went into the mid fours, about 190,000 feet. And that one, that was in the high twos per square foot. So, good core infill property, credit tenant, not as strong as Amazon, but still a credit tenant. And, that's in really high demand. Some of the more flex or, that's occupied or incubator stuff that's occupied by more local tenants is a little more dusty, a little more of a challenge, because I've seen, there's some account receivables that are piling up on some of those deals. So you've really got to be careful when looking at all of these types of buildings in the industrial sector to make sure that your tenancy is healthy. And the market is going to nick that if it's not. What are you seeing? Are you seeing consistent trends in what you've been appraising?
Yeah, I think our first run at these when there was no market data was we were slowing down growth in rent, and and knocking up credit loss. But I think we've really kind of toned that down quite a bit, and are really seeing very little value change quarter over quarter with most industrial properties. I agree with you. If it's more of an entertainment type industrial use like the gyms, those are problematic. But otherwise, there's strong demand. And I think because some of the other markets are hurting, you're seeing investors maybe jump over to industrial. So that market could even improve. What are your thoughts on that?
Yeah, well, on the institutional side, there really isn't a whole lot allocated to retail these days. So I think a lot of that shifted more towards the industrial for the.
I agree. Yeah.
Yeah, and there seems to be a lot of demand from private equity as well.
Have you seen much market activity in the industrial sector over the last 5 months?
Yeah. We like I said, we've seen a considerable amount for last mile in e-commerce type, and the data center market, even though it's not really industrial, but it's in those markets is very, very strong, particularly in the Ashburn area and Loudoun County. We're just still seeing some good activity there. What are you seeing on the office side? This market is so heavily driven by office tenants. How are you approaching that?
Yeah, the office market to me in many ways is the toughest because there's a lot of opposing factors going on here. First of all, the office market in general had been hurting over the last couple of years as companies have kind of reduced the amount of space per employee. So we've had generally high vacancies, even in Arlington, which had historically been in the single digits, has been 15 to 20%. So that was before the pandemic. So now we have the pandemic and we're not sure where the market's going, but at the same time, we have Amazon coming in, and obviously that's going to have a positive impact, especially in the Arlington market and probably Alexandria market. The bigger question that I have is how far reaching is that positive impact going to have on Reston and Tysons and even further out west in Loudoun County? And other questions, you hear the debate, and I think this was talked about on Tuesday, of, are companies going to reduce their space because people now have learned to work at home, and so there could be more telecommuting, or are they going to need more space because they're going to have to spread people out? I don't know what your thoughts are, Jerry, there. I think in the end it's going to be more of a negative, but what are your thoughts?
Yeah, I don't think it's going to be positive. We're actually in the process of planning our Tysons either renewal or move right now for our CB office, for all of our lines of business. And they're wrestling with that right now. And I think that's still evolving. But I tell you, we have seen in second quarter a decent amount of demand, mainly from the tech center, the tech sector out in Reston, and a little bit in the RB corridor in second quarter. I mean, you've had huge blocks of space taken down by Facebook and Microsoft and similar types of users. So they do plan at some point to reoccupy, and they're looking at a pretty heavy growth as a company. But again, the sublease space is starting to tick up, and that indicates that tenants are looking to downsize a bit, or they've moved into better space.
I think another trouble spot.
Do you see
the shared office space is going to be an issue. Obviously, WeWork was already having problems before all this, and now are people really going to want to share space with strangers and different people every day? So I think there's so much of that space out there that might create some problems. It already has created some problems.
Have you seen any shifts with any of the properties you've looked at from urban core out to the more suburban buildings where there's not as dense and they can make their employees and their guests a little bit safer?
I haven't seen that yet, but that's been talked about quite a bit, which is interesting because a lot of the non-metro suburban office buildings, before the pandemic they were basically thought to be just dead, and they're being, some of them, one of them was
Hello?
and I'm not 100% sure or convinced that it'll totally change it, but I think there could be some tenants who would rather be in a more spread out area and have surface parking and so forth. So that certainly is a possibility. I haven't seen any specific signs of it yet. I don't know if you have, but it's an interesting dilemma that's going to take place in the market here.
Yeah, hey, it's funny. On underwriting, I actually just received some underwriting from one of our stronger brokers in terms of how they're underwriting office buildings, and I don't think it's too different than what we think. COVID's low impact is really on core assets where they're 90+% leased, credit tenants, 10+ years of weighted average lease termination. Now, you're not going to find a lot of those, but clearly they're having little effect in terms of pricing on these assets. The high impact that they're finding is really on the value add, and it shows there's really nothing on the market right now. Who would sell into this if they don't have to? Your properties with high vacancy, little contractual income, and heavy debt burdens. So when they're pitching deals, they're actually adjusting their underwriting, by increasing vacancy by 2 to 5%,
Right.
flat growth 2021, 2022, no absorption in 2020. Now that may extend out into first quarter as well. Increasing TIs from $5 to $10, and their leveraged IRRs are up 50 to 100 basis points. So, we haven't hit things quite that hard yet, depending, unless it's really, a challenging property. We just did a building in Tysons where the main tenant was Hair Cuttery, and, they went bankrupt, and they're going to be pulling out of a lot of, all their retail spaces, but also some office space. So, in a market where you've already got high vacancy and there's, you don't have a lot of the core tech growth that's happening, that those are going to get hurt.
Right.
At least that's what they're seeing.
I know you and I were talking about the sale that took place out in Tysons that Meridian bought on Greensboro Drive that was initially under contract for, I think, about $63 million, and was renegotiated after the pandemic to I think about $56 million. So about a 10% hit,
Right, and that was B- product, B product,
right.
On the wrong side of the road. So those properties we're seeing a decline, even though there's not a lot of data points. It's pretty obvious from the anecdotal evidence and from what we're hearing from our from the market participants.
Right. All right, you want to move on to retail?
Yeah, this is the fun one.
Yeah, really is.
Let's get a little positive here. The single tenant deals, the credit tenant leases, they are just rocking. C-stores, drugstores, freestanding grocery, fast food, ground leases to retail, Dollar Generals in some of the more remote Virginia markets. Cap rates have been at or below where they were prior to the pandemic. They're secure. The demographics are right, and the sales per square foot, store sales per square foot have been increasing. Now, our brokers, they had 6 to 7 properties on the market pre-COVID, and now they're all on hold at their recommendation to the clients, that they don't need to sell. Most investors are waiting for phase 3 opening because they're very concerned about the accounts receivable on rents, which tenants are really going to have long-term problems, so they can get a better handle on it. So the underwriting is really all over the place. But with that said, if you have a a really well located retail asset, where most of the rent is being generated by grocery stores, essential tenants such as drugstores, takeout restaurants, pad sites, fast food, there's going to be little value decline. There may even be, there's some argument that there may be a slight value increase, but I can't say I've gone there. And it's interesting, the centers that are farther out from the core are actually doing fine. COVID isn't as prevalent out in those areas, and most of the population isn't as concerned about it as they are in the more denser properties. But the biggest hits are the properties with the big box anchors, in the non-essential tenants, particularly movie centers and gyms.
Right. I've seen that.
20, several gyms have gone bankrupt. Gold's Gym's parent went bankrupt. They're selling to a German investor, and they're looking to do more online type of programs. So that could keep a lot of them afloat. But I think there's going to be structural changes there. I mean, who's going to a movie theater on a Saturday night, over the next 6 months? Not me. Maybe, duck out during the day to go see a matinee, but anyway, there's some distancing. I'll give you another example. I have a very good client. They manage or own 65 properties, 1,750 tenants, $3 billion in real estate. In April, 1,100 of those tenants didn't pay rent at 40% collections. Now it's trending up. I spoke with him yesterday. In August, it's about 65 to 70%. The tenants have been paying rent. And when you appraise a retail property in any market, but in these market conditions, you've really got to get a handle on who's paying rent and who's asked for relief and how that relief is being handled and what's the condition of that tenant. And then you could look at the revenue from each of those sources and kind of weight vacancy and risk accordingly to kind of come up with your rates.
We've also had to look harder at co-tenancy clauses too. Co-tenancy clauses are always there, but now they're even more important since there's a more of a chance of the lead tenant bailing out, and that just is a domino effect in some cases.
Yeah. Well, what he was telling me is that a lot of these co-tenancy clauses, the tenants are coming back for help and that type of stuff. They'll do it, but they'll negotiate, better co-tenancy clauses in favor of the landlord and get some concessions there. But again, with some of these tenants, you don't really know how they're going to make it down the road. It's not just, they could defer rent to the back end of the lease and a variety of other techniques, but I don't see how some of these tenants are going to make it. A lot of the movie chains are now in bankruptcy. And, most of the underwriting questions we really can't, it's very difficult to answer today because you call one client and call another client and they give you totally different underwriting parameters. Deals over 25 million are very tough until CMBS or Lifecos come back. Private equities are pretty active, and from what I understand, they've actually been fairly aggressive on some deals. And we've seen, nationwide, CBRE has seen deal flow increase, by about 20% over the last quarter. So that's not a bad thing.
That's good to hear, because I know there hasn't been much activity around here over the last 5 months, retail-wise.
Yeah. So, but again, you got to look at your location, your demographics, and where your rent is coming from. And if, you're going to get a good part of your center that doesn't work there, some of these properties can be repurposed, but others, there may not be much value in this market to a movie center component, or a very large gym, or even some of the smaller gyms where, they've packed it in too much. And, particularly for tenants that are struggling day to day, it's a very challenging market. And let's face it, once this is all kind of cycled through, there's going to be a lot of space that's available on the market, with restaurants going out and hair salons and other types of facilities, other types of users that just weren't able to make it. during that time period.
Yeah, I agree. One of the things that, not a specific property type, but one thing that I've seen just in general in the market is quite a bit of activity of smaller properties, owner-user properties, whether it be office condos, small office townhouses. You know, a lot of the small banks are doing just tons of loans. There's transactions going on. So there's a bright side there. There's a lot of activity in that type of property, and it's kept me very busy the last few months.
Have you seen any pricing trends there? Has there been any declines that you've seen in some of those?
No, not really. Not
deals?
really. The office condos are still, you know, at the same level pre-pandemic. So no, I have not seen declines there. I think it's similar to housing.
We've done some smaller.
Yeah, it's similar to the housing market.
We've seen some smaller industrial deals as well, and these owner-user industrial deals. We haven't seen much pricing contraction in those either. Have you worked on anything? Just back to the office. Have you worked on anything in Crystal City? Oh
yes, we worked on a renovation deal. That you know, they're obviously trying to repurpose for Amazon coming into town, and there's all kinds of, you know, even during the pandemic, there's still interest in leasing that space. So I think that market. You also have Virginia Tech, obviously putting a campus there too. So there's just so much activity there that's, you know, it's hurt by the pandemic, but I think it's just delaying things a little bit. So.
Yeah, and Virginia Tech's definitely moving forward. You and I had we were two of the three appraisers working on that, and
right.
You know, they were pretty gung ho even during the pandemic to plan it and move it forward.
I think that's about it. I'm a little hurt, Jerry. You didn't say happy birthday to me. You know, after all, we've known each other so long, and you don't no birthday present or anything. I think Rob's going to give out my contact information for people to send gifts to me. Contactless cash is preferred.
All right. Well.
Anyway, Rob, I want to thank you for putting this together. It's a great program, and I think it's good to have everyone's opinion. We really appreciate it.
Yeah, both of you guys, I appreciate your time today. To the attendees, I want to apologize. We're having a little bit of technical difficulty here that we're on the Nova team. But this is two of the top minds in valuation in Nova, DC.
That's a scary thought, Bob.
No. And Tom, again, happy birthday.
How'd you hear?
We will be passing out Tom's email and cell phone number with the materials later next week. So you can, as he requested, cash is preferred.
Contactless.
Yeah. And he's the bright age of, I believe it was 38.
57.
Yeah.
57.
Yeah. All right. I want to take this chance to thank everyone that was involved today. Emiliano Flores and Nick Mills from CoStar gave some really good economic information. Thank you guys both for your time. The Southwestern Triangle, Mike Russell, Joe Thompson, and Billy Hansen all had great information for all of our valuation folks on the line. Stuart Holtzman touched mostly on land and timber, but then did sprinkle in some Fredericksburg in there for us. Appreciate your time today, Stuart. I know all of us are covered up in production right now. And Jerry and Tom, thanks again, especially working so smoothly through the technical difficulties as we had them. We also had Steve Noble and Charlie Persico on today. We're out of time though. So maybe at the next time we all meet again, those two will get to chime in more with us. Thank you all for your time today. Have a good afternoon.